Hey, good afternoon, everybody. Mike Shea, Transworld Business Advisors, and Michael Hershaft, Celtic Bank. Mike, thanks for doing this with me.
Hey, my pleasure.
The purpose of this video is going to be that Mike and I are going to rehash a conversation I think we had three months ago, 4 months ago.
Good, around there, roughly earlier in middle of 2022.
When I'm done with this video, I'll plug a link into one of the pop-up boxes so people can go back and reference the video where we talked about SBA lending and what we forecast about to occur. And it's going to be kind of, hey, were we right? Did we see the tea leaves correctly? And I know it's going to be hard for everybody to, divergently look at my cool background, which is just my home office, and Mike's cascading array of Star Wars figures, including the Death Star, in his office. So, Mike, when we were last talking about SBA, we were still doing a decent amount of loans. I believe the prime interest rate, or what the effective lending rate we were dealing with, was somewhere in the sixes. Is that right?
Either upper sixes or low sevens. Yes.
Right. So today, what is the lending interest rate that we are generally seeing from banks?
Sadly, 10 to 10.25%, which would be anywhere from prime plus 2.5 to prime plus 2 3/4.
Okay, so in your layman's non-economics, I think the last time we talked specifically around how when the Fed raises rates and it's designed to limit the amount of money lent by the banks and how that has a conciliatory effect of slowing down the economy. Can you kind of explain why the banks are doing what they're doing now and why they're at 10.5 or 10.25 and 10% and how that happened?
So the SBA rates are, the base is prime. So as prime goes up, that's that's the primary factor of why the rates are higher. And then the banks always have a buffer over that. So any, deals are going to be anywhere from prime plus 2 to prime plus 2 3/4. And, every bank is different how they price it. A lot of SBA lenders sell their loans on the secondary market. So that's what usually justifies the quarterly adjustable rate or even a higher rate, prime plus 2 3/4, prime plus 2.5. There are some lenders who do portfolio their loans where they'll do maybe prime or prime plus 1. They'll fix it. But with some of those lenders, because they're going to portfolio, they're looking for A+ paper. So
explain that. We're about to get into
yeah.
To everybody's kind of reflect back to the housing crisis. Banks make money on loans. They're not doing this for Jesus. The points are margin, right?
Right. Correct. Yep.
And banks aren't there. When everything's, it's the SBA. It's not the SBA.
Correct.
The SBA is just guaranteeing it.
Yep.
The bank and their balance sheet and their appetite for the types of loans, and they do lots of different loans, ebbs and flows with how much money they can make and what they forecast risk in the market to be. So
that's correct.
When Mike's saying they're going to sell it on the market, there's got to be an appetite on the market, right? So they says they have to be good loans. Talk a little bit about that, because back around October, Celtic in particular stopped doing what I call Mickey Mouse stuff, like the $300,000 loans, the little stuff, because you guys weren't making any money on it.
Yeah. So the problem with smaller loans is there's a lot of work that goes into SBA loans, and just it's cost prohibitive. So even 2023, I mean, I raised my minimum loan size to 400,000, just because anything under that, it's still somewhat cost prohibitive. But like Celtic, and I'm not plugging Celtic, I want to speak generally, but like we'll do anything that's eligible. So we're not restricted on anything. Every lender has a different credit appetite with what they'll do or not do.
So stop there. Explain that, because when I'm dealing with business buyers, generally are buying their first business. They don't usually buy 2 or 3. That's the rarity, that's the exception, not the rule.
Right.
So it's kind of an unknown how business lending occurs. It's not like housing where you'll sell a house, or a person may buy a house 4 or 5, 10 times, right? Business loans are rare and they're highly risky. So,
Correct.
the appetite of the lender, and you all are about the same. I mean, now what I always tell people is, look, try to banks have a portfolio on their balance sheet, and if they got a lot of housing and the housing market's tipping, they've got to pull back from a risk standpoint, right? So all
Yeah.
this
So,
contributes to the ability to even get a loan.
right. So, if a bank has a certain industry or a certain type of loan that goes bad and it's large, sometimes there's a knee-jerk reaction by the bank's credit department saying, all right, we're not lending to that industry anymore. We had a loan go bad, we're going to lose our pants. We're done with that industry. We won't do it anymore.
For example,
Or let's see. So I remember back in the day, I hate to use this as an example, but like Quiznos, the franchise Quiznos.
yeah,
A lot of banks took up, like I remember when I was at Banco Popular at the time, they did Quiznos loans and a lot of them went bad. So as a lender, if you were a broker saying, hey, I got someone buying a Quiznos, I couldn't help you because we
yeah,
wouldn't touch a Quiznos for anything.
sure,
But there's other industry specific. Certain lenders won't touch a restaurant.
right,
They don't care what it is. Some lenders will not touch a hotel.
sure,
Actually, Celtic is the first lender I've been at that likes hospitality, so I could actually fund hotel purchases. But there are lenders who will not touch a hotel,
right,
just because they either had one that went bad or something happened where they're not comfortable with it for whatever reason, or they just took a massive loss and they don't want to go through that again.
sure.
So
Okay, so back to the original question, how is it now we're at 10 and a quarter from 6 3/4,
well,
7?
that's the Fed trying to control inflation by raising the prime rate. So basically to deter borrowing, or I don't want to say business growth, but almost business growth, they're trying to deter spending to some degree. They're trying to control the inflation that way, which is they're raising the prime rate to do that, to increase the cost of borrowing money, whether it's as simple as a credit card purchase, buying a house, getting a business loan, even buying a car, etc. So everything.
So I remember when we were on the last video, why was, because the ebb and flow, it's always this trailing, the Fed, you could be living in la la land, everything's hunky-dory on the street, and the Fed looks at indicators. And I get up in my morning, I got a big screen and I'm watching CNBC, and they're looking about credit card defaults, auto loan defaults, delayed mortgage payments. Those types of things are indicators of some rough seas coming. And the average consumer is like, living in la la land. The Fed responds, it trickles over to the banks, the bank respond, and then it constricts the amount of money that's happening in the market. So what's the net effect to business borrowing and business transactions at that SBA level?
It's just more expensive money. So if you're a business owner or a business buyer or whatever, and you need to do something for your business or start a business or buy a business, it's just reality. The cost of the money is just going to be more. And it just has to make sense. Does it make sense economically for the business and for you? And are you comfortable with it?
Right.
So businesses are still borrowing money. They're still getting loans. People are still buying businesses. I mean, so it's still happening now. Is it happening a little less right now? Yeah. Could be time of the year as well. So sometimes this is time of year, it's a little slower. Taxes aren't done yet. People are figuring out what they want to do for the rest of the year. But it's going to take
So
3 to
pause
6.
there. So pause
Yeah.
there. Footnote to the buyers and sellers on the off chance you read this, particularly the sellers, get your freaking tax returns done right now, because the next Fed meeting, there's a damn good chance there'll be another interest rate hike.
Yep.
And that quarter point could tip you one way or the other on the deal. So if you're a larger transaction, I generally say if it's a purchase over 300 grand, it tends to have some type of financing involved. You got to be able to get your books and records done, because it come April 1, the accountants are going to start going to drag mode. You need to be jumping on it January, February, get your books settled, done, tax return filed, get it SBA on, because if we go a quarter point higher, that's 10 and a half. That's 10.5%, right? That's
Yep.
almost 5 percentage points higher than we were half a year ago.
Yep.
And that's crazy. That's going to have it already is. And I'm not going to say, Mike's right. Deals are still happening, but the types of deals are going to be completely different. And you got to be perfect in the mind of the bank in order to get that transaction. Any hair on the deal leads to something else.
The other thing that banks are doing, Mike, and we're doing it to a little degree, every bank is different on this. When we're underwriting it, we're actually putting a stress factor on the interest rate, assuming that, hey, it's a variable rate loan. The Fed may raise the rates again. What does this thing look like at, a point higher than the current rate, or 2 points higher?
Right.
So that's another thing from a cash flow perspective. It really depends on how the deal looks, even with a little bit of a stress factor built in there.
Right. And the SBA already had that ebb and flow. It's always that 1.5 ratio, right? Doesn't matter if you can cover the one-time ratio, you got to have 1.5 for the stress issues. Now you guys are going magic 8 ball, and your analysts are going, what does the next year look like? Next 2 years look like? And the economists at your bank, you got, bean counters and spreadsheet Nazis going, well, we think it's going to go to 11, right? And will the thing service the debt or not? And that's not something we dealt with in the last 5 years. Yeah.
No. And Mike, I remember when you and I spoke probably about a month or two ago, you sent me a listing of yours to pre-qual. And I had a question for you on this, because I want to know how you're handling this with your buyers and sellers. So there's been times in the past where if I get the deal to or if I get the deal to cash flow, then there should be no valuation issue with the business, right? What I'm seeing now, because of the interest rates being the way they are, I still think some of these businesses are worth, from a valuation standpoint, what you're selling it for. The problem I'm running into is that I can't get it to cash flow because the money's too expensive. The interest rate's too high in my loan. And it's not a knock on the seller or the value of their business, because the business is worth it. It's worth what you're selling it for. It's just that there's not enough cash flow to repay it. So how are you as a broker addressing that? Are you telling the buyers, too bad, you got to kick in extra money because the price is worth it? Or do you tell the sellers, listen, even though your business is truly worth this, if someone needs financing, chances are you're gonna have to come down in price? Or do you do it just a case by case?
I tell you, I saw that occurring, when, now that I'm an old man in the business, the cost of capital now means something to me. And now I have a context to how long that, this probably may not be the right word, the elasticity on the time frame of that cost, how it impacts the loan. To the buyer who comes in and the seller, this is all gobbledygook, right? And I sometimes struggle trying to make it clear to them. I'm like, look, it's a 10-year loan. It quarterly shifts. We're trying to predict what it's going to be, in 2 years, 3 years, because that's what the bank does. That's the third leg on the stool of the table. And I say, if the cost of capital is high, the buyer's only, and inflationary pressures on eggs, milk, gasoline, labor, all those things contribute. They put stress on the amount of cash flow on the deal. It makes the deal untenable. I mean, I have people who just won't listen. And it's probably a failure on my part. This is part of the purpose of this video is, God, I hope somebody goes back and looks at what we said and what we live today, and we can go, I'm not Nostradamus, but this is not rocket science. Something's got to give. So either the seller gets creative. I mean, I'll give you one I did on the 31st. I did a $2.3 million deal. And it was an automotive shop. It's been there for 35 years. And the seller did not want to do the phase 2. $2.3 million deal. Because he was offended that they said they suspect, it's an automotive shop for 35 years. There's going to be a phase 2. I told him that the day I met the guy. I'm like, that's not even open for discussion. It will occur. Well, I'm clean. It doesn't matter. Doesn't matter. No one's going to believe you because you said so. And I said, as soon as you do that, you have to do seller financing. That's it. You've lost your leverage. There's no other source of capital. No one's going to give you 2.3 because they know you don't have options. So if there's 100 buyers and all buyers want to use SBA and the SBA has these requirements, guess what? The only way you maintain some type of transactional value is to seller finance 1.7. Yeah.
Yeah.
And, the mechanisms, the controls, the protections were there. It was very complicated, but we got it done. It was secured by land, which, was, you could do some things with title and the rest to make sure it was real. But, it is a problem for the seller and the buyer. And oftentimes the sellers will always leave financing up to the buyer and go, oh, it's up to you to figure it out. It's not my monkey. Like, well, it is. They need to understand this process to be creative and flexible on deal structure, because without it, it's not going to be real. So, go back a year ago, we were in Denver, we had your meeting, and then I had our IBBA meeting, and we had our internal conference, and Cagnetta is on stage going, hey, y'all need to list up on pizza parlors, breakfast lunches, freaking lawn company, little stuff. And I went to the crowd and I'm like, to all my franchisees, I'm like, do you know why? Do you know why? And they're going, I don't get it. I'm going, see those storm clouds? That's what Andy's talking about. The storm clouds are the interest rates and the net effect on the constriction. And then that's going to drag for a while until because it takes sellers a while to kind of adjust. So
Right.
6 months ago, you and I called it. Now it's come to pass. They're going, oh shit, excuse my language. And then they have to adjust. And they're going to adjust like this. They're going to just go little nickels and dimes until they settle into the number. That's why it takes a year to sell a business. It's because they don't want to face reality. The one who faces reality the quickest understands that lag gap. Okay, Celtic Bank, best in class, 60 days to close, right? Interest rates are every quarter. You almost got to have to tag out this timeline of events that have to occur, and you got to convince them to get on the mark. And then, the broker, the salesman is there trying to convince them of the things to do. And they've got their advisors and their friends who, whatever. Their opinion is, I guess, as good as yours and mine. And we're going, don't you see? It's almost like you ever see that movie, The Poseidon Adventure, the old one with Gene Hackman?
Yeah.
Yeah. And he's in the ship's flipped upside down and you're going the way out through the bottom of the boat.
Yeah.
Gene Hackman going, follow me. And everyone's like, no, we'll just stay here. And then the freaking ship explodes and they all die. I'm like, y'all need to follow me. And so how I'm handling it is I'm having these events with people like you to kind of go, look, no context, consume it as which you will. I don't know your specific case, but this is a banker telling you X. Go back and look at what we said 6 months ago. It happened. There's a good damn chance we're right. So take it for what you will and make your assumption. And then on the interfaces, in that 30-minute, 45-minute conversation where they're going, well, I need this amount of money to retire. I'm going to go, well, that's not going to happen.
Yeah, you have a little bit of a tougher job sometimes because you're dealing with all the personalities at once. Usually when you get it to me, you've kind of set everyone straight, you've diffused the issues, and then everyone kind of knows they have to play well in the sandbox. But I don't want to be in your shoes, dealing with the seller with their personality and what they need to get for the business, and then what a buyer's willing to buy it for, and putting it all together.
Well, hindsight, Mike, is 2008. Like 2008 taught those of us who were around a whole lot about the ability to forecast what's about to occur. So, I always sit at those IBBA conferences and I listen to the various different people opining about what's about to occur. And I'm kind of a half full guy anyways. But this seemed like an epiphany. Once you understand that banks are there to make a profit and that they hold different things on their balance sheet. I was not an economics major in college. So, the understanding of how the Fed works and how it relates to the bank and all that stuff, that goes over a lot of people's heads. But it's like, this guy lends him money, this guy's got to make points on it. And then he's got a balance sheet of housing loans, which cause a collapse. I mean, remember 2008, everyone nothing's being lent. We're hoarding cash. It's emotional. Yep. So, Celtic's a pretty conservative bank, right?
Yeah, we're pretty middle of the road. Yeah, I wouldn't say we're too
don't
aggressive.
Take crazy leaps. There are other banks that do, and you kind of have to. I always tell people, stay away from the people who do a lot of housing loans, like a ton. Stay away from them, because that's going to be subject to the volatility of the lending market. I mean, I'm in a BNI group, right? Mortgage guys got a second job. The realtor's packing up. The freaking home inspection, that's drying up. Well, what's that going to mean for lending, right? There's all these soft water indicators of of the lending market and how's it going to contribute to ours? Well, what I think is about to happen is we're still running through big deals. We had some, I mean, I did 2 at the end of the year, did an SBA deal, 2.3, no note, done, but it was perfect.
Right.
Beat the ratio by a quarter point, 30 years of history. Guy was on the board of the bank. So, there were some auxiliary pressures that allowed the deal to go through, but they still called me and say, will he hold paper? I'm going, are you kidding me? No, he's not holding paper. I pushed back and okay, we'll do it. But what I'm doing is trying to educate the parties that you're about to hit a patch. And I think it's going to last about 2 years. Not that the rates are going to go, but the rates don't move like this. They move in quarterly increments. So it took us 6 months to get to 10, right? It's going to take us at least that much to get that if we go there, and we're not at the peak yet.
Right.
So, I'm thinking 1.5 years, 2 years before we start to see a dip.
Yeah, definitely not this year. It'll be in 24 sometime, because it's got to level out, and then hopefully they'll start dipping. And I'm using the word hopefully, but
Yeah.
I agree with you. Minimally 24. I don't see it going down this year. If anything, it's still going to go up. We're expecting a quarter point increase in February, and then who knows what's going to happen after that? Probably another quarter. I don't think they're going to be as aggressive going a half or 3/4 anymore. I think they're going to do it in quarter point intervals. But again, I'm like you. I'm not an economist, and I don't play one on TV, and all that stuff goes way above my head. I truthfully, I don't really understand it that much. So all I know is, I'm looking at the rate that I'm trying to sell, and again, sometimes it works and sometimes it doesn't.
So I did have the one I did on the 30th, and the gentleman was 75. And I think I'm going to see a lot of these baby boomers. We're still haven't seen that crew hit the market yet, right? They've waited again. Those who are still out there have waited too long again. And we're going to be having conversations and this is the one I had with a guy when the valuation came back, because he had interest rates went up, consumers dipped. It was a restaurant, and the number in his cash flow dropped by 200 grand.
Oh, wow.
Yeah. He went from a 2.8 valuation to 2.3 valuation, like that.
Jeez.
And I'm like, cost of eggs, cost went up, your labor went up, and your number of customers went down. You still cash flowed, but you cash flow at this price. And he's like, well, the emotion flipped. I'll just keep it. And I had to look at him and go, you're 78. You're 78. Do you really want to be 80 doing this again? That's the conversation we're having to have with people. And I literally looked at him and said, if you were my father, how much is enough? Because you're not going to, this is where the hard conversation, you're not going to be healthy. Stuff stops working. Stuff, it's harder. Your body starts working. You have more doctor's appointments. I go, come on. I mean, stop. Be serious. I mean, how much is enough? Is it because you don't want to be here and talk to your wife, or you don't want to recognize there's an end to this? We all have a time clock, but there's a legacy to your family. You have to prepare. And that's like that. And entrepreneurs are hard. They're just a different breed. But how are we handling it? That personally, those are the conversations I'm having, and they're not always sound. They're not always fun.
Oh no, I bet.
Most of the time I've known this person 3 or 4 hours, maybe a week, maybe 2. And I'm having to have a conversation about the legacy business they've built and going, you probably need to cash out and move on. But the reality is you're going, hey dude, 2024 is when this thing adjusts down as the cash loosens up. So it's not a year, it's 2 years. And that's not a reflection of the broker, because the money in the market is infinitely more expensive. So, that's reality. It's not rainbows and unicorns. There's no magic powder other than, guess what? Your seller financing.
So,
right?
So Mike, let me ask you this. I know you work with a lot of banks, as you should. Have you noticed any banks tightening?
All of them. All of them. You're all tightening. Like, you guys all borrow at the same rate.
Yeah, no, it's true.
And anybody who discounts or is like a crazy town, you're losing on something else, like service and the ability to get the loan done, or in the terms, right? So it's like an apple's an apple. I frankly tell people that I don't really care. The most important factor for me is who your BDO is and the ability to communicate with the bank and where will they be afterwards, and your ability to manage your business with them afterwards. Because getting the loan ain't that hard. I mean, after I get you approved, it's just paperwork. It's pretty standard stuff.
Yep.
You're all the same in that regard because you're borrowing from the same entity. And the SBA portion, in my understanding, is a relatively small part of a bank's portfolio, relatively speaking, in terms of number of loans, et cetera. But you're all doing the same thing. Everybody's pulling back. Everyone's having these conversations. So you're not the first person I've had this. I mean, you're the only one I video it with, but I've talked to Jack, talked to Tammy. I mean, for the parties out there, everybody in the industry knows everybody, and we talk every day, and we know what's happening. And so everybody's kind of going, holy crap, 10 and a half, 11. And they're all, tightening the wheels, or pushing. Like the last one we did at the end of the year, they were pushing to get it closed because they were afraid of another interest rate hike.
Right.
They're like, I'm like, you got to get this done. You do not want to wait another day. Why? Well, because the bank could say we're changing tomorrow. That loan letter we wrote you can change on a dime,
So someone once used the term, deals are like fish. The longer they sit, the more they smell. And it's true.
Yep.
You never know, because you can have a deal that's approved, and then if it goes back to credit committee because there is an interest rate hike, does the deal still work? And the bank could say, especially if a commitment letter is expired, wow, then there's no holds bar on that. The bank could say,
yeah, I mean, look,
that
in the last one, we had to go back to committee because the buyer wanted to put more money down because his financial planner convinced him to put more money down because of the interest rates hike. Well, guess what? The whole damn thing started all over again. Had to go back to committee, and I'm going to the buyer, and he wasn't my client. I'm like, younger broker, and I'm going, dude, are you out of your mind? You don't put it, once you get it past, the papal committee, you don't run it by the Vatican again. You go, good, I got the blessing, I'm out, I'm moving.
Right.
Oh
yeah.
You don't send it back up for review. That's like asking the devil a second to bite of the apple. Don't do that. But my financial guy, your financial planner is not the bank. He doesn't.
There's no prepayment penalty on the loan. If you want to make a principal reduction after you close, have fun with it.
Right.
Not right now.
Right. Don't run that risk. So it leads to another discussion, which is the hardest thing to have discussions with people is the seller note discussion.
Oh, I bet.
Because that's how stuff's going to get done now. So explain that and how that has to be done, in the next 24 months. If you're going to get deals done, seller notes, and how that impacts the cost of capital for the buyer.
So one thing for you to convey, to your sellers and even to your buyers, if they are going to do like only seller financing, just let them know that a buyer can't refinance that for 2 years. If they want to refinance it with an SBA loan, right? Now, the potential good side to that is hopefully, like what we just talked about, hopefully interest rates are going to start coming down, beyond the downward swing. So if a buyer and seller can last for the 2 years, then hopefully they could catch the wave on the downside, and then the seller could get made whole, and then the buyer can, go along their way. On a deal, let's say we're doing we're financing a transaction and part of it's seller financing. Then we just have to incorporate what's the payment on the seller note as well as the proposed SBA loan, because we have to make sure there's enough cash flow to service both loans, right? We want to make sure the seller's getting paid on their note. So that's why we really want to see that there's enough cash flow there to not only repay the SBA loan, but to repay the seller note. If there's not enough cash flow there, then we could potentially do, a year standby or a 2-year standby. But I don't like having the sellers have any type of standby. I like when sellers can get paid on the note day $1 one.
Right. So, when I bring seller notes up to people, they always freak because they worry, they liken it to, I put 20% down and finance the balance, which is basically what happened on the 31st. But that's not what generally happens. It's usually like you're carrying a smaller portion, 10, 15% of the note in second position behind the bank's note, and you're collecting interest, but not getting paid. And what this does net the cost of capital conversation is it lowers that debt service so we meet that ratio. It allows the buyer to get to that position that the bank is comfortable, get the transaction done.
Sure.
I generally tell people finance the amount of the fixed assets because, the banks aren't going to want freaking, forklifts and freaking, truck parts. And it's just that's what I tell you, because your risk is smaller.
Right.
And, they're collateralized, they're, personal guarantees and all the rest of the stuff is put in place to make it work. Problem is most of the time they're poisoned by other people's opinions. So, oh, never do that, or I did it. And I always go, well, did you do it with a bank? And was there a broker involved, and who drew up the seller note? Because there's usually some default there. It's like they did a handshake deal, got it off of Craigslist, and they wrote up their own paperwork because they were too cheap to hire an attorney and file the UCC lien. I'm like, well, then you deserve everything you got, because you didn't spend the $500 on an attorney, right? So seller notes are pretty standard. They are effective. They work. We put the proper teeth in place, and we make sure
banks love them.
Yeah, we put, if you got a deal that's tight, Mr. Seller, you're going to do seller financing, get that thing over the hurdle. Because guess what? It doesn't matter if you shop it to a different bank. It generally, and by the way, the brokers know who the good banks are, the bad banks are. Like I could rattle off 3 or 4 names of banks I would never do a loan with, and they're the huge ones because their balance sheets are completely jacked. They've got a mortgage securities division. They're selling freaking stock. And then, we all know who I'm talking about. Don't do an SBA loan with those 3 letters. It's a bad idea because they're more volatile. They may be bigger, but they got other stuff, and trying to get things done in a timely manner is difficult. I always say, hey, smaller bank, do a little seller note and get a damn thing through the papers as quick as possible. And 99.9% of the time, everything goes kosher. I've had 1 in 20 years that went haywire. So, and they collected on the guy. They took his house. So, if done properly, it's a safe mechanism.
Right.
So Mike, we got 5 minutes left. We rambled. What's the message for the next 12 to 24 months for sellers and buyers?
I would say, and again, this is my opinion for what it's worth. I agree with you in that I think interest rates have not peaked yet. I think for the rest of this year, we're probably still going to have a couple of increases. Hopefully it's just a couple. Hopefully it'll then level out. And then by 2024, at some point, we start to see the rates start to slowly come down. That's what I think from an interest rate perspective. From the lending side, I mean, speaking generally, I know how we look at things. We're looking at deals the same way we've always looked at them. So like we're not having a knee-jerk reaction as far as like we're not going to touch this industry, or we don't like this because we think it's going to affect this. We're looking at every deal individually. So we haven't blacklisted anything. I could still look at anything. I mean, we were financing hotels during COVID. So we still look at every deal individually. So we don't have a box per se where if 9 out of 10 items are in the box and item number 10's outside, we can't do the deal. No, we look at each deal individually. I'm just curious from other lenders as far as like, have they stopped lending in certain industries now because of what's gone on with the interest rates or because inflation? Or from an underwriting perspective, have they, instead of having a 1.25 cash flow coverage, do they want like a 1.5 now or 1.6?
1.5.
Really?
Yeah, they've backed off on the industry kind of agnostic stuff like COVID, post-COVID, restaurants were a non-starter. And some of the hospitality stuff, until we showed them, and like you read the tea leaves wrong on this. Yes, hospitality was impacted, but not this vertical within hospitality. So sometimes we had to educate, and that was really like you had to have a senior BDO who kind of been around a while, because if I gave it to a junior, they're not going to win the argument because they're just too young and naive about how to argue. Things like property management. Oh, it's down. I'm like, no, actually everybody moved here. Right. So,
right. Yeah.
Right. So you missed the boat on that one. Right. But they're about 1.5, not 1.25.
I would also say to your buyers, regardless of which lender you go to, listen to your broker, listen to Mike, because I know as you as a buyer, you want the lowest fixed rate possible that you can get. And the problem that, you're probably going to run into as a buyer is you're going to get enamored with a lender who's saying, yeah, I'll get you a 10-year fixed at this. And then you're going to spend probably a month to a month and a half going through the underwriting process, gathering your paperwork, and then all of a sudden you're going to get declined.
Yep.
It's unfortunately, the variable rate is probably going to be a reality, and it's something that you should probably get used to. And if you just can't get comfortable with it, then you probably have to look at a different source of financing if you're going to buy a business. I mean, that's my opinion.
No, I think that's fair. And pretty much everybody I know is out there at variable. They say fixed and then they'll switch to variable. But look, if every quarter, remember, the banks are making money. If every quarter the Fed's doing a rate increase, the banks can't afford to be at it. They just can't. So we're looking at least 2 years before you start to see fixed rates again. My opinion. I haven't seen a fixed rate loan in a while. So,
gotcha.
I pretty much say it's going to be a variable and that's the end of the story. And they're like, well, my banker says, I'm like, well, are you being sold? Because you are, and I don't care. I mean, do what you want. I'm at a point in my career where I really couldn't give a damn whether you listen to me or not, because I was going to be somebody right behind you. And that's not cavalier. That's like, look, I want you to get the deal done. And there are only certain ways to do it. And math is math, right? That's it. Math is math. And
my first conversation with a borrower, the very first one, it's a variable interest rate. And if you own property, you're going to pledge it.
Yep.
And because if you can't get comfortable with those two things, I can't help you.
Right. No, nor can anyone else. You're going to pledge.
You're probably going to have a hard time finding someone who can help you, but especially with the house. I mean, that you're not getting around.
Nope.
But, just good luck to you. I'm just let you know that you've heard it from me first. So if there's another lender promising something else, and then all of a sudden your commitment letter looks different than the term sheet they gave you, they swindled you.
Yeah.
So,
and you spent 20 grand on
correct.
cost. Yeah.
Yep.
All right. So we got about 30 seconds left. Give everybody your contact information and I'll send this out to everybody.
Sure. Again, Michael Hershaft with Celtic Bank. My phone number is 407-615-0329. I'm also at mhershaft@celticbank.com. And, regardless if we're going to use Celtic or not for financing, I'll always talk to someone about their deal and just give them my own opinion on their request, whether, again, you're going to finance something with us or not. I just want to be upfront and honest because, unfortunately, there are people in our industry who are not.
All right. Well, thanks, Mike.
You got it. Thanks for having me.
Bye-bye.